Nike is now sitting at a new 52-week low at around $73. Now remember, over the last 12 months, this company is down nearly 32%. And as a reminder, the reason for this, the shares just in one day were down around 20% after they reported their earnings a few weeks ago. And it clearly wasn't a good set of earnings as well. As we can see, they reported weaker than expected quarterly sales. And on top of that, not only did they lower the outlook for the year ahead, but they projected that revenue would actually fall, so a negative by a mid-single digit percentage, and they talked about this being a lot due to the slowdown in the consumer demand for their products. So let's take a look, understand whether or not we should be looking to buy. Now straight away they have a dividend safety score of 99, so it does look to be very safe, and this is a company that does historically increase their dividends at a very nice rate. Now, one thing to note, it was reaffirmed just a few days ago, even after essentially their earnings, which was a bit of a crisis. It is very safe. A dividend cut does look to be highly unlikely. Now, for those that do see a recession inbound, well, past performance, how did they do? In fact, they increased the dividend in the last Great Recession, 07-09. They had above average growth, negative 6.6 versus the S&P's negative 12, and they significantly outperformed negative 36, as we can see the S&P during that time, negative 55. Now, in terms of dividend increases, well, we love to see this, a high single digit last November, double digits over the last 5 years, double digit over the last 20 years. So historically a very strong dividend growth company, and they have increased those dividends for the last 22 years. They're 3 years away from becoming a dividend aristocrat, and as we can see here, 40 years of paying a dividend without a reduction. Now, when we take a look at dividend yield theory, it states the company is undervalued when the current yield sits above the 5-year average. So this is a severe undervaluation signal. In fact, this is the highest yield this company has offered over the last 5 years. We also note a double undervaluation signal as the forward P of 23 does sit below that 5-year of 31.9. And when we do take a look though, we do see the sector as a whole, consumer discretionary, much lower. In terms of the free cash flow payout, as always, we want to see below 60% on the channel, and it has been pretty much below that every single year, 49% expected over the next 12 months. So we would be surprised if we don't see at a minimum a nice high single digit increase to the dividend. Now on the free cash flow per share, as always, consistent increases over longer term. Now they're not consistent, but they do move in the right direction. Over the next 12 months though, we are anticipating a small drop from the 2023 number. And when we do look at the sales growth, as we can see, whilst we do like to see 3 to 7%, historically it has been around that region, although some years, like that COVID drop, it was negative. 2024 flat, and as we said, over the next 12 months, they are anticipating, even though a small drop, they are anticipating a drop to their revenue. Now, historically, in terms of their numbers, well, 31 billion in 2015, 51 in 2024, and what we can also see, they do return a lot of excess cash to shareholders through those share buybacks year on year, although we wouldn't say it is very consistent, but we can see this is part of their capital allocation nonetheless. And then we take a look at the ROIC, one of my favorite metrics to look at for all companies in general. This does give us faith that management are able to effectively allocate their capital if we see it 10% or more, consistently above that level and in the mid-20s over the last few years. So that does look very attractive to potential investors. Then we talk about the margins. Now we don't see any operating efficiency. The margins have remained fairly flat over the last 10 years. Same to be said about the free cash flow margin. Nonetheless, it is above the minimum 5% that we want to see, 12% looking nice on a trailing 12-month basis. We then get to the net debt to EBITDA, so this is the earnings before interest, tax, depreciation, amortization. We want below 3. Now look, 0.05 in 2024 indicates the number of years it would take the company to pay off all of their debt net of cash on hand. So they have a very strong balance sheet. The dividend is incredibly safe, and even over the next 12 months, this isn't anticipated to move much. So we can see overall this is a very good sign for a company that is going through a fairly rough period. Now back to the company itself, as we said, it is trading towards, or if not at its 52-week low, down 32% over the last 12 months. If you've been a shareholder, well, over the last 10 years, you would be up 90%. Bear in mind, we're going to come onto it, but you would have underperformed the S&P. And we can see all-time highs sitting around that $180 mark, nearly 3 years ago today. As we touched upon as well, the forward yield does sit around that 2% level, forward P around the 23, not too far off in fact the S&P level right now, and we do get one buy rating from Wall Street and a double hold from the other two analysts. When we take a look at the company in terms of their top line increase, as we just touched upon, we can see over the longer term it has increased, in fact 30.6 billion to around 51, and graphically we can see over the long period it is moving in that right direction, but we should have that expectation that next year the numbers will be dropping from the previous. And one thing that we didn't look at is that bottom line net income, but we can clearly see over the last 10 years it does move in the right direction, 3.3 billion to 5.7, although a little bit different with their bottom line. Unlike the top line's consistency, we do have some years like 2018 and 2020 where it did drop from the following year. So just something to bear in mind. Maybe we can touch upon this when we do look at that margin of safety in the valuation part. We then look at the health of the company when we talk about their total cash versus their total debt. 6 billion of cash short-term investments on the balance sheet in 2015, nearly double that, nearly 12 billion in fact in the latest quarterly report. So we can see over the longer term their cash position has been increasing. That is nice to see, moving in that direction, but as always in isolation that number doesn't really tell us anything, which is why we always compare it both numerically and directionally to their total debt. Gone from around 1.3 billion to around 12 billion. So as we did see earlier, net debt to EBITDA very low, very strong balance sheet, although we do note similar to their cash position over the longer term that total debt has also been increasing. One thing we always like to do is how did they perform against analyst targets on the earnings per share as well as forward-looking estimates. Well, over the last 4 quarters, they did beat APS quarter on quarter. That is a 100% track record. Granted, they did miss on that revenue. And the next quarter, that is a massive drop, negative 43% year on year to the EPS. In fact, over the next 4 quarters, they are anticipating a drop. Again, something to factor in. There are always reasons why companies do drop in terms of the share price, so we are starting to understand the bigger picture. On top of that, if you do have faith in management's estimates, well, in terms of their May 2026 projection, that will bring the forward P down to around 20.55. As we keep moving, the next part of the analysis talks about some underlying metrics like the valuation, where they get a D-. One of the reasons for this, even though they are trading essentially around a 23 to 24 forward PE, the sector median is trading much lower at 15. So right now you are paying a premium around 57% for this company. But as always, there could be reasons why you could justify it on other metrics that we will come on to see whether or not it is warranted. But pretty much across any valuation method for this company, it is very poor, a C or a D, essentially meaning you are paying a premium for this company in the sector. When we look at growth, well, not a great sign. Valuation higher than the sector. Also growth looking worse than the sector, which is never a good sign. Revenue historically, well, it did move 0.3% over the last 12 months. Even though the sector median grew very small, nonetheless, it was larger at 2.3%. And forward looking, realistically, they should say -1%, -2%. We can see the sector as a whole, whilst it is again low single digit, it is still positive as opposed to the negative that the management team are estimating. Again, we can pretty much see a very similar theme throughout where they are having poorer grades than the others in the sector. And one thing that really strikes us out here is the earnings per share over the next 3 to 5 years is anticipated to grow at 6.74%. As we can clearly see here, sector median much better at 11%. So you should really be asking before you buy this company, why are you paying a premium as opposed to the sector? As we can clearly see, a lot of sector metrics are significantly better. We then move on to the profitability. Nice to know A+, so we are starting to see something where we can say that Nike is performing better than others. Gross profit margin, well, 45%, as we can see the sector lower at 37%. Bottom line, that net income at 11 versus the sector of 5, which is again a positive sign. Pretty much they are having a very good profitability metric within this company. And when we do talk about their cash from operations, very high, over 7 billion, with others around 275 million. So for a quick summary, there is a buy rating from Wall Street, although Seeking Alpha and Quant give it a hold. Valuation D-, growth D, and profitability A+. Now, another question you can ask is this something that is common within the industry, which we are going to find out now? Are there issues, or is it just solely in isolation for this company? So we're comparing it to others like Deckers, On Holding, Skechers, Crocs, some of these that you may even say are their close competitors. And when we take a look at this company, yes, down 31%, bear in mind this is including reinvesting those dividends. In fact, they are not only the worst performing, but the only one that had a negative performance. Every single other company did return positive over the last 12 months. Over the last 5 years, pretty much a very similar result there. We see that Nike negative 11% and the only one with a negative performance over the last 5 years. Pretty poor for any investment to be negative over a 5-year period. And when we look over the last 10 years, slightly better story. They are in the middle of essentially the competitors, around 113%. It doesn't say the next 5 to 10 years are going to be very poor, but as always, past performance isn't an indicator of future, just something we include within our analysis. The other question you need to ask is, do you see it outperforming the S&P 500 over the next 5 to 10 years, or whatever your time horizon is? Because if the answer is clearly no, or you aren't that confident, just put your money in a low-cost ETF like VO for the S&P. As we can clearly see, over the last 12 months, S&P 500 has significantly outperformed, and that is generally the theme over the last 5 years, as we can see with the blue line, and over the last 10 years. Now, the one thing that I would say here is very interesting, that pretty much any point over the last 10 years, as we can see by the orange which depicts the Nike shares, we can see that you would have outperformed the S&P. However, it wasn't until the recent drop that we had a few weeks ago where actually you underperformed. So what this signals is there is a lot of risk with individual companies. You could be outperforming the S&P for 9 of the last 10 years, but if something happens in that 10th year, as we can clearly see, there is that underperformance. As always though, do your own due diligence before doing or executing on any of these companies. We then move on to insider ownership, 0.5%, around 44 million worth of sales by the insiders over the last year, with some buying but a very small amount in comparison at 1.5 million. However, when we do take a look at the more recent quarter of Q3, no movement yet. Quarter 2 though, the last quarter, we had a lot of selling, around 20 million. In comparison, the buys were very, very trivial. So who were these insiders who sold? Well, as we can see, the chairman on the 14th of May did sell a massive 168,000 shares for around $15.7 million. Now, this was when the share price was significantly higher at $93. Whether or not you believe this is a bearish signal and it puts you off buying the stock, again, completely up to you and your own investment strategy. We would just say that insiders sell for many reasons, whether that's personal or financial. Institutional ownership, well, just over 64%. We do see nearly 10 billion worth of sales, but we see a lot more buying, 226 billion worth in fact. And what we would say in the more recent quarter, a lot more buying, 6 million versus nearly 1 million worth of sales. So institutions still very bullish on this company, and the same is to be said over the last few quarters as well. As we said though, never copy insiders or institutions. Always be comfortable with your investment strategy before you execute. Now, before we look at the valuation, just to let you know, today we have released our latest free weekly article. If you want access to this or any other articles, it is all completely free. By clicking on that pinned comment below, you can read, again, instant access. And in today's episode, in fact, we did release a free spreadsheet that runs through all of the undervalued dividend kings. So make sure to go and check that out. So now we jump into the valuation model where we get our intrinsic value of $100. Now, very quickly, just to run through how we got this number, the first model we used was the multiples valuation. We had the P multiples of each company, the average, multiplied by the EPS of this company to get that intrinsic value of just under $100, as we can see our first undervaluation signal. We then moved on to the second, which was the dividend discount model. The average growth was around 11%. We went a lot more conservative at 6.5%. As we can see, that undervaluation signal. And our third undervaluation signal, we use the DCF model, the free cash flows. Average growth at 40%, so we went a lot more conservative at 9%, also lower than the more recent increase of 10%. We use the discount rate to get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, arrive at the equity value, divide by those shares outstanding, and as you can see, that intrinsic value at $97. So the intrinsic value was just the average at $100 of these three models. And as always, if you do want to grab a copy of this, you can click on the pinned comment below to run your own numbers through. But our current price of $73 does indicate a nice margin of safety. At 10%, this would be a buy at $90. At 15%, this would be a buy at 85, and we keep going until it hits that current trading price. And we can see in today's episode, it is pretty much around a 25% MOS at $75. For those that are looking at 30%, well, maybe you wouldn't have to wait too long. It does sit around 70. So today we're sitting at somewhere between a 25 to 30% margin of safety. Remember, as always, we start off with a minimum 10% margin of safety on those companies that we believe to have a wide moat, strong financial metrics, and good forward-looking data. Now, in terms of Wall Street, they also see this as a buy. As we can see, even though they have revised their price target down to $94, they still see upside of 29%. And for those that do believe this is a high-quality company and they will turn things around, they're just going through a rough patch, then this could be a great opportunity to buy this high-quality name. As always, though, do let us know your thoughts below. Is this one you have been buying on the drop? Are you continuing to buy? Or maybe you sold it a while ago and you do believe that their moat is essentially coming to an end. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.